My name is Triffany Hammond. I'm a support and resistance trader, and what I'm going to go over today is taking a longer-term view of support and resistance, dialing it down to a time frame that you like to trade, and really all you're doing is taking the time frame that you like to trade in and putting it in a larger support and resistance type context. And I use the daily and the 4-hour down to the 1 hour because I like to trade the 1 hour the best. But I really do like to take my signals off of the daily and the 4-hour charts for a couple of reasons. A lot of the price points and volatility and goofing around that the market will do during the day gets absorbed into those longer price points, into those longer term time frames. And by the end of those longer term time frames, I get kind of what the market's final decision was on the whole ordeal, whether that was the final decision of the day or the final decision for those 4 hours. Because if you're watching how many news announcements come out each day, how many meetings happen, across the world with each board's, version of the Federal Reserve, and how much happens in the course of a business day, there's stuff that's constantly moving the market up and down and back and forth. And going to a slightly longer time frame allows me to kind of put that final word on it. Just see what the final word of the market was for how they're going to respond to the market action in the first place. So that's why I do what I do. Now, like I said, I like the daily, the 4 hour, and the 1 hour, but you could apply this to the 4 hour, the 1 hour, then the 30, or right on down the time frames. Now, we've been talking for the past several weeks about the pound dollar, so I guess it's kind of become our pair. But let's go ahead and stick with it, and we'll talk about what it looks like it's doing right now, because we have had a lot of whipsaw action and a lot of, a lot of indecision in the marketplace again. There for a while, it was really easy to take bounces and get good risk to rewards on trades. Last week, we saw a lot of tightening up, a lot of consolidation, a lot of very quick movements with quick retracements, ultimately just to kind of end up right back where we were anyway. And we're kind of seeing a little bit of that this week. But here's what I'm looking at in terms of putting it into a larger context. On the daily chart, which you should see in front of you, pound dollar daily chart, what we have here is these two. Remember, we labeled our important level way up here, and look how often it's used it. Well, at the bottom of that level, we have an important level as well. Now, someone else might like theirs to capture the tops of these bodies and the bottoms of these wicks. I happen to just like it here a little bit better, where I'm catching the bottom of these bodies, the top of that body, and almost the top of that wick. So right away, we're into a conversation about what support and resistance really means, because it's very difficult to find a support and resistance level that is a specific price point. And what you end up with is that support and resistance really is kind of a zone, right? Inside this zone, that's where the market shows its indecision, its fear, or its enthusiasm. Hopefully that makes sense. So what we're seeing, as this price came back inside this larger level, this larger support and resistance zone, we see that it's approaching the top part of this support and resistance zone, this area of indecision. So what we want to do is keep this level in mind down here, because as we get closer and closer, the separate price points inside this zone are going to get harder and harder to hit. Think about that for a second. If the market is fearful of going this low, you can see here how it was fearful of going this high once, came down, hit this zone, and immediately reversed up off of it. The second time it came down to this zone, it bumped in for a day, and by the close of the business day, it came right back out of it, tried it again, rejected it here. So you can see how this zone becomes an area that the market is hesitant about. So if the market is hesitant about an area like this, why should we be enthusiastic? We want to be careful at the price points in between 59.50 and 60.50. That's a 100 pip move in there where the market's going to be really goofy. So if we go and we decide that we want to take a 100 pip trade and we're going to get in at I don't know, 60.75, and our plan is to get down to 59.75. Can you see how that gets in here and it hits one of these areas where the market might be fearful and where the market may do something like this to you and come really close and miss it? This becomes an area we want to be really cautious of in terms of planning our trades. We don't want to get caught up in one of those situations where our profit target is just barely tapped and our limit didn't execute because of spreads, or it became, a pip or two away from getting us out of the trade. It's a very frustrating situation. So now that we have kind of this area down here that we're going to be cautious of, and we recognize that this is making its large swing inside of this larger consolidation area that it's respected before, and knowing what we know about currency pairs, that they'll make a large swing like this and then come up and tighten up, make not quite as high a high, not quite as low a low. Could do that 2, 3, 4 times. It could really do that for a while. Right now, we're kind of in one of those places where this could come down and tap here, or this could be the end of its wild swing. You can see right here at this price point, I could have just as easily drawn in this gray line right at 61.52, and it grabs this wick. It nearly hits the bottom of that body. It almost touches these wicks. It hits the bottom of these candles. You can see already where we might be in a situation where this is already showing hesitancy near these levels. We're not making any decisions right now. We're just finding the context of the pair. Mike says that it looks like a head and shoulders. Great. Mike, I'm really glad you spotted that. Here's a couple things I want to say about the head and shoulders. For starters, I would have been much happier with this head and shoulders if it would have come from this upswing. I really don't like head and shoulders that come off of consolidation patterns. You can see how this consolidated into this head and shoulders instead of really having the oomph, the drive of a buying market with indecision and impulsive move and then indecision at that same level again. Head and shoulders, in my experience, are much more a valid signal if they come off of the upswing. Same thing with an inverted, right, an upside down head and shoulders. I much prefer to see those straight off of the downswing rather than coming into it from consolidation. However, what Mike is noticing is that same sentiment, where we had fear at this level, uncharacteristic buying at this level, which it freaked out, returned to sender, and then showed fear at this level again, right? You can see how the sentiment there is the same. The other thing I want to say about a head and shoulders, and you guys, everything I say today, I want you to take to the drawing board. I want you to take to your back testing. I want you to come to your own conclusions. If you disagree with me, I want you to write to me about it. I want you to talk to me about it. Let's get you engaged and present in your own trading process. Let's get you actually involved in what the charts and what price action means to you, because these are really important conversations to have. When I play a head and shoulders, and I do, I really like patterns on the daily and the 4-hour chart. They lose some of their statistical reliability smaller than a 4-hour chart, especially triangles. Triangles are a nightmare on 1 hour or shorter. In fact, we can talk about the dollar yen. It was making a really nice ascending triangle this morning, and I said, I'm not trusting it until I get a fake out to the short side. And that's what they do to you on 1 hour and shorter. But anyway, whole different conversation. But here's what I wanted to talk about head and shoulders. Here's what the point I was getting to. In the equities market, the rule of thumb for head and shoulders is to go for 100% movement from the neckline to the top of the head. And again, here's a subjective thing. Does the top of the head to you mean the wick or the bodies? To me, it means the bodies because I have more hits. I have a hit from that wick, and I have a hit from these two bodies right here. That's a 640 pip move, 639 pip move. It has been my experience that in the Forex market, it is much, much safer to take the more recent price action, which is the next shoulder. So let's see where we're at. Oops. First, before I do that, I want to actually take a look at what support and resistance level I want to measure this from. Yeah, that looks good. So I'm going to take this most recent price action right in here, and I'm going to see where that puts me. And has this head and if this was a real head and shoulders, has it played out? And you can see 100% level, which is really just 100% of the move. I'm just using the fibs as a very easy way to find, where that profit target would be using the shoulder instead of the head. And you can see how it nearly came down to that level and has actually chosen a consolidation level right inside this movement. So that head and shoulders, in my mind, is nearly played out. Maybe one more little dip. But that aligns with the support and resistance we're talking about anyway, right? That might make one more dip toward this area that the market shows fear anyway, and discourages us from getting too anxious and excited about getting down into this market, to this level where the market shows anxiety, right? For resistance and support, you look also to the weekly and the 4-hour chart. I will sometimes have to go to if we haven't hit highs that we've hit in a long time, like a lot of the pairs right now, about 3 weeks ago, look like they were trying to get to higher highs that they haven't been to in months. So then I have to go to a weekly chart to find a support and resistance level. Yeah. But I don't generally, it's not something that I keep as a part of my trading journal or my trading journal, my plan, my watch list, right? I don't necessarily always look at the weekly. Okay, so not to beat a dead horse, let's get down to the 4-hour chart then. We're going to see if we can't make more sense of what's going on with the price action. So here is that consolidation area that we were talking about. And you can see how we can start to kind of refine and make some other decisions about where we really want these support and resistance levels. As we dial it in and we get to the time frame that we like, you can see how I might be willing to grab some of this. Now, these represented themselves as wicks over here, but now I could grab the bottom of those bodies, and they align quite nicely with the top of my box. And actually, I'd rather take the most recent price action here. I'm going to make my box just a little bit bigger if I can grab just the box. Hello, there we go. Okay, so this becomes then the consolidation area that we want to watch. And what we're seeing here, let's take a look. We're seeing sharp price rejection at anything above this box. The market, as much as it was fearful down in this zone here, it's also fearful of anything long right now. What we're starting to see in terms of what is driving price action. You remember last week, for those of you who are regulars on Tuesday, first of all, thank you so much. It means the world to me. I love that you're here. But second of all, we did talk about, in order for the market to really have risk aversion on the front burner again, something significant is going to have to change. Some big thing is going to have to change. And as much as the market is anxious to get back out there and trade again, they want their carried trades. They want to be able to sell those dollars and invest again. As much as they want that, they are watching every little piece of news that comes out. They are watching for any indication that this worldwide recession is in recovery. We thought we were getting that with first quarter news. We thought we were getting that with some of the summer months, even though they were slow, there were steady signs. Well, Britain, in their news last week and this week, have really shown that maybe we were jumping the gun a little bit. So now the market's looking for, is that big enough to make fear the picture again, to make fear the story again? And that's really what we're seeing with a lot of the whipsaw action, not just in the pound, but certainly in regard to what we're talking about with the pound dollar. The whole world is watching the major economies. So something like what's going on with the pound or with Britain's economy and their economic news, and maybe things aren't as good as they once were, that actually does tell a larger story for all of the currencies. Because if there's hesitancy in one area that we expected to recover quickly, that we thought were diligent about, their economic policy and trade and all of those things, then it's likely that other markets aren't doing as well as we had all hoped as well, too, in addition to also. So what we want to as individual traders be careful of is keeping that context in mind. If the market's looking for a reason to be excited, We want to look for reasons the market might be excited. We want to jump on board when the market's showing excitement. If the market's looking for reasons it might want to pull out, we want to start looking for some of that as well, because we don't want to get in a situation where we're swimming upstream. Mike asks, can you briefly explain carry trades? Briefly, in a nutshell, it is the selling of low interest rate currencies to buy high interest rate currencies. And people who use carry trades are interested in only the interest rate differential. They don't care about spot price. It's a long-term position that is held just to take advantage of that interest differential over months and months. And that's the reason why it really took a long time for the carry trade to respond to the market fall anyway. And when we started seeing signs of recession and failing economies at the beginning of last summer, and the carry traders, they held on and they held on and they held on, and all of a sudden it was like there was no money there anymore. The interest rates were all coming into kind of a homeostasis, and everybody was trying to manage money supply and interest rates as a course of action to answer some of the problems that we were facing. Because carry trading is really something you have to have for a very long time to make the money off of it. It's an investment. It's different from a trade. It's an investment. And those people that didn't get out of that carry were hurt big time. Big time. So anyway. Let's see. September is seasonally an upset month. So to what extent do you expect strength in the dollar and the yen in September? Well, first of all, one of the reasons why September is so highly volatile is because September, is kind of the end of earnings season. So a lot of times people are making larger decisions based on whatever has happened over the course of the summer. Big companies saying where they're at in terms of growth and development and what's coming down the pipe, or maybe the opposite, right? Closing down plants and moving factories and all that sort of thing. So September is very much a reactionary month, but really only the first couple weeks in September. But that's been historically, right? We're in new times right now. Right now, in terms of dollar strength and yen strength, I think that it's going to be from a strictly fundamental standpoint. I know we're getting away from the technicals, but these are really great. These are really great questions, really great topics. We have some major shakeups going on in terms of what's going on in Japan right now. Last week had a lot of Japanese news. This week has a lot of Japanese news just from fundamental announcements. But you couple that with what's going on politically there. And Japan has found itself in a very unique position right now where it is really trying to marry the two things that has to happen for them. They need a strengthened economy. Most of the big banks, most of the big traders that did a lot of that carry trading were individual investors. They had their IRAs. These are Japanese families that got hit really hard by what we were just talking about in terms of the carry trade. So individual investors that found themselves, in November and December, where many of us and our families found ourselves with our IRAs in August and September of last year. It just took a couple months, I think, to hit them, and it hit them for different reasons. But so they need a strengthened economy to put the people back on pace. But then you put that on the other side of things and what they have to do as a matter of trade. I mean, Japan's notorious for weakening the yen on purpose, right, to keep their exports affordable worldwide. So they are, and now that they have a new political party in power and they've got a lot of political shakeups going on, I think what we're going to see across the board is yen strength. I don't think it's going to happen right away because people are still wanting to use those carry trades. But I think ultimately when push comes to shove and everything's, pulled out and all the cards are on the table, there's going to have to be a large amount of yen strength as people get fearful there and pull their money out of the market until they figure out what's going on with their political party, what's next on their plan for economic recovery, because everything's kind of up in the air for them. And anytime an economy gets fearful for their for any reason. And a lot of times it's not even necessarily fear. It's just, hey, there's major changes, so we want to do the safe thing and pull our money out. Then that country's currency will strengthen just on the fact that they're buying back their currencies, getting them back out of the market. So then the next question was, how can you know which support or resistance line will hold on price, and how can we enter a trade when price is on support and resistance? Let's talk about that as we drill down into it. This is a great example. Look at this break right here that's going on. Okay, we'll talk about this in just a second. So for the carry trades, how big must an account be since price may go against your position? Yeah, you have to have an account that handles the drawdown. And really, it's not, a carry trade really isn't something that individual investors generally do. I know a couple traders that just had a separate account that was strictly for their carry trades because the spot price does experience quite a lot of drawdown, during some of the whipsaw actions because, yen pairs are highly volatile. So in terms of how big of an account, well, you'd have to figure out when the carry trade becomes a safe way to trade again. You'd have to figure out what you have to gain versus what you have to lose the account and do the math. Thoughts on the pound Swiss? Yeah, we can take a look at the pound Swiss a little bit later. We need inflationary pressure to increase interest rates and to enter positive carry trades. Yeah, well, we have a whole interesting thing that happens, when gas prices go up, and I know that gas isn't really, I don't know why it's not, but it's not really counted in CPI numbers that drive inflationary data. But, what we really have is the cost of living going up. We have temperature changes globally that are changing what we have in terms of supply and demand for agriculture. We have energy costs going up. We have, because it's costing more for companies to make stuff, all of those prices are going. So the inflationary pressure is there. But I don't think that's going to be enough to really make any major change right now because it's keeping consumers fearful, right? They can't afford to go buy stuff. Then they can't afford to go buy stuff, and the economy kind of stalls at that point, at which point, we're kind of in this push and pull where there's sort of been this market cycle where inflation can rise and interest rates can rise and respond to that, and the money can become cheap again, and things can kind of have this natural ebb and flow. But we really are in unique times right now where what used to work for us may not be the answer for what we're in right now because everything kind of has this counterintuitive feel, So anyway, that's a lot of fundamental talk for a technical presentation. Do I trade fundamental news or mainly stick to technical? I'm mainly a technical trader, but I think it's really super important to understand what's going on in the marketplace. I had my trader development course yesterday, and we actually went over some fundamental correlations that can make for really good trading. They've kind of come decoupled right now because we have this whole money supply issue, but when they work really, really well. And we talked a little bit about that. And, the argument is always there that price action does reflect the fundamental picture. You don't have to really understand the fundamentals to see that the market's jumping on board for a sell side or the market's jumping on board for a buy side. And although that's true, I think it's kind of unfair to yourself. If you've decided to become a trader for a living, you have basically decided to go into business for yourself. And if you were to go into business as a retailer for anything, it would be up to you to know exactly what you were up against. Who is your demographic? Who are you going to market to? Who has money to buy your product right now? And do they have that money now, or is there a seasonal thing? It's your job to know what the market conditions are for your business. And if you've decided to become a trader, and if you're not treating it as a business and you're not paying attention to what is driving market price, you're doing yourself a huge disservice. You're not, first of all, being as educated as you possibly can about what you do for a living. And second of all, you're not doing what's necessary to make the changes in your mindset and in your consciousness to re-identify yourself as a trader. Fundamental stuff is boring. It's boring for most people. And most of us didn't grow up with an understanding of it. It really takes, it's like learning a whole new language. And it really takes a very conscious and deliberate effort to learn what's going on in the fundamental picture. And if we just say to ourselves, well, I want to learn this, but I don't want to learn that, then we really haven't identified ourselves as traders. And if we really haven't identified ourselves as traders, our consciousness has a really difficult time making the transfer from just toying with it, I'm figuring it out, I'm going to play with it, to the leap of, hey, I'm a trader. This is important. This is something that I want to learn about. This is something that I want to talk about. And, glean ideas off of other people and get broader perspectives on and really dive in. And without that shift in consciousness, without that shift in your belief system, trading will always be difficult. It's always going to be a push and pull, and if you're lucky, you'll become a break-even trader. So that's just my thought on the whole issue. How long would you say usually to hold on to a position as a technical trader? If I trade things like daily patterns, it'll be days, weeks. On the 1 hour chart, usually I'm out in a day or two. It seems to me that to make profits out of technical trade, you need to hold for a long time, a few days at least. Well, it depends. I know a lot of people that scalp. And when I mean scalp, I'm saying like 5-10 second charts. And they'll pick 2-3 highly volatile hours. They'll go in, get 3-4 pips at a time and get out. 3-4 pips at a time and get out. And they make money doing it. So it's all about what you need to do to be comfortable with how you trade. It really doesn't matter how I trade or how other people trade. You don't have to say, I have to hold on to something for days or weeks to be able to make money. Because honestly, not everybody's psychologically able to hold on to a trade for that long. If you can't sleep at night, you're not trading well for you. You need to find a different way to trade. As a technical trader, what tools and indicators are most important for you and your trading strategies? Price action, first and foremost. I do also have an 800 simple moving average. That's this purple line here, and just default settings for the MACD. Yep. Yeah, you're welcome. See, how long would a fundamental trader hold on to a position for? Fundamental trading is generally a long-term thing. I say generally because there are exceptions. When the technical and fundamental, and now I should be more specific. When the fundamentals that are a part of the economic news releases are in correlation with what goes on price action. Right now, they've decoupled. They're starting to come back into play. They're starting to realign a little bit, but they've decoupled from what they used to be. Then you can trade fundamental price action, or you can take short-term fundamental trades based on what your prediction is for the fundamental news release. So, for instance, let me just give you an example of what that might look like. If you're looking at something, a market-moving announcement, like the PPI, Producer Price Index, what that index is it's telling you what producers are paying, or what producers are charging for what they produce. Well, there's some common sense involved. If the previous 3 announcements that have come out about commodities, if commodities are getting more expensive, if why am I drawing such a blank right now? I'm totally drawing a blank right now. If the announcements before it are saying that things are getting more expensive for producers, manufacturer prices, ISM numbers, if things are getting more expensive for producers to make what they make, it's a pretty easy extrapolation to say, well, producers are going to have to raise their price. And then you can make a short-term prediction on what you think that PPI number is going to be, if it's going to go up, if it's going to go down, if it's going to be positive or negative. You can kind of start looking, you can make those correlations and make fundamental trading a short-term thing. However, most people who consider themselves fundamental traders are very long-term, and they trade in a very specific and a very different way because they have to hold on to their trades for so long. And what their fundamental predictions can mean is that they might be right on the money, but it's difficult to time. So they can enter a trade for fundamental reasons, end up holding on to the trade for a very long time, and experience quite a lot of drawdown during that time until things turn back around for them. So that's a completely different way to trade. And generally, fundamental traders don't look at charts. It can really muddy the waters. Now, Forex options are a really nifty way to trade fundamental. My fundamental analysis is usually about 2 weeks ahead of time. So in a situation like that, it's a really good idea to take a look at something like Forex options, which it's a whole different study. Don't just dive in. I mean, you really have to take your time with options and understand the risks and rewards there. But what you're essentially buying when you buy an option is time. And you do allow yourself some time, some lag time between what you think is going to happen before the market hits it. So it's not the same kind of drawdown experience that you have in something like spot trading, which is what we do here. Good. I'm glad I'm explaining things well. Do you look to scale out even, then take profits from a portion of your trade? Yes, there are times. Yes, absolutely. I'm not really an all-in, all-out trader. I scale in and I scale out generally. Pound Swiss plummeted 150 pips in 15 minutes earlier today. Would you buy it now and at what level? If we have time, we can look at the Pound Swiss. We haven't even really finished looking at the pound dollar. So we'll see if we can get over to the Pound Swiss. The Pound Swiss is just kind of stuck in a consolidation range right now. Oh, well, there was your trigger right there. There's your bounce. Came down to the support level here. Printed some reversal candles. There's your confirmation candle. If you wanted to go long, that's a great support resistance level. I'm not making a recommendation. You and I haven't sat down and looked at that. Oops, wrong pound dollar chart. And looked at it closely, but just eyeballing it, Jerry, because you're asking again, which is apparently really important. It looks to me like it's making a bounce off of that consolidation level low. What risk to reward do you like? At least a 1-to-1. I prefer a 1-to-2. Do you also teach options? No. No. I don't teach options. I'm trying to think. Interested in learning. Oh, the ISE is a great place. They have a ton of tools there for free. A lot of webinars, and everything's archived and extremely easy to get to. Go to, what's the web? Look up, I think it's ise.com or ise.org. But that would be a good place to go. And isn't there a cap to options? I'm not sure what you mean by a cap. If certain spreads will limit the amount of money you can make, but they can also limit the amount of money you lose. But those are different spreads. Just an all-in, all-out position is just straight out buying a call, in which case you've limited your risk, but you can, up until the time of expiry, you can take advantage of as much growth as inside that as well. Options are a completely different animal. Okay, yeah, drilling down. Jack says fundamental traders also look at chart level project and project future levels. Yeah, but while they're in those trades, it's not like they're analyzing the technicals. They're not really concerned generally. Fundamental traders are very much about what's going on in terms of market news. I'm a chicken for not teaching options. Yeah. It is a .com, so you're on it now, thanks. No, ISE. So let's see. Let's write it down for you. So that looks like that's it. Oh, thank you. John shared it here. Fantastic. Somebody else is look at what a great group you are. You're so supportive. Oh, that's awesome. Look at you helping each other out. I love that. That's awesome. Okay, so really quickly, because we are running out of time. Wow, we had some great conversation, though. What fantastic conversations to bring up. I didn't expect to go fundamental today, but hey, it works. Okay. So what we're seeing here on the pound dollar is some of that tightening up that we were talking about, where we couldn't get we We had this one swing and couldn't get to ultimate lows, couldn't get to ultimate highs. We had fake outs here. It looks like we're getting some fake outs here. Let's see what this looks like on the 1 hour chart. We're seeing a lot of impulsive movement here. What this means is if you're a channel trader, what you might look for, if the range is large enough, you can look for things like this, where this comes down, you get undecided candles here, and you get a confirmation candle. Now, clearly right here, you don't have a good risk to reward. You're going for just a few pips to hit the top of that channel. And of course, your stop would have to go below the lows. But this is the kind of behavior that you want to watch for. Honestly, because the tightening up action that happens in Forex, so much more than it does in equities, I actually will sit out and I'll wait out until this whole consolidation area gets broken. The nice thing is if this really stays in this area for a long time, for quite a long time, the breakout can be really explosive and it can move very quickly. So when I identify these levels on a 4 hour chart, I like to go to a 1 hour chart. And on a 1 hour chart, for me, the trigger on this would be a close outside of this box. And here's what I'm talking about. You say, okay, if I'm going to go for 100% of the most recent price action, just using the fibs is an easy way to calculate that. That brings me right down to the middle of this zone where the market is fearful. Now, if I didn't know that, I might just go for that 200% level. But knowing that the market is showing fear and knowing that on a daily chart, it's actually every time it hits this area, it gets a little bit higher and higher. Why would I go that deep? Instead, what I would like to do is go to the 161.8 level, which is just above that area, takes out some of that risk for me, gives me a little bit more confidence in my support and resistance trade, and that's what I'd be watching on the short side. If I saw it break out on the long side, now you could get in if you saw a good bounce, couldn't you? But then you run the risk that it comes up to like a secondary high, like right in here maybe, without getting all the way up there, which if you still get a good risk to reward, take the trade, my gosh. But if you don't get a good risk to reward, I mean, that's something you have to kind of watch on a case by case. But knowing that 161.8 is safe based on recent price action down there, doesn't it make sense to stick to it on the top side? Now, right off the bat, I'm looking at this and I'm seeing here that even though this the 6400 area matches the fib level that matched on the short side, you can see from a support and resistance level, it really doesn't make sense. I'm asking to get to higher highs than the market's been willing to go to traditionally for support and resistance levels. So wouldn't it make more sense to find a support and resistance level that it's been able to hit before? And if you wanted to get even more conservative, you could come to these highs here. Again, depending on what this looks like when it breaks out, if you get a secondary low in here that you can put below and you can get a good risk to reward, then that makes sense. But I'm now in a situation where I'm trying to quickly just wrap things up. So you can see why last week, there was a lot of the same behavior. I just didn't get a lot of triggers on trades last week. I like to trade. It's kind of a bummer when I don't get good setups. But I'd so much rather stay out of the market when I'm not secure in my trading style. If I don't have trades set up that I know have a good statistical probability, it is silly for me to take them. Then trading becomes gambling. Then psychologically I start to tear myself down, right? Take a dumb trade, you beat yourself up over it. Why did I do that? I'm stupid. I shouldn't be trading. I'm a fraud. La, 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 la. So don't even put yourself in that situation. It's okay sometimes to stay out of the market. Being a trader for a living doesn't mean you always have a trade on. Being a trader for a living means that you are taking high probability trades using smart money management, following a well laid out plan and structure for your trading business. And it takes a lot of self-discipline to follow through, and it takes a lot of patience and courage to stick to your plan the way that you need to. But it's uber important. It's super important that you understand what conditions you are able to take good statistically probable trades in. And if those setups aren't there, walk the heck away. That's okay. If you're feeling like you're somebody who's compulsive about trading and you just can't help yourself from trading, take a micro account somewhere that you fund with $50 each month and you trade for pennies per pip just so that you can take trades. Just so that in that account, that's where you do your stupid trades because you're compulsive and you just can't stop trading. But the money that you have that is your trading capital that you intend to make money off of, be smart with that. Treat it like gold. It's a precious commodity for yourself. You put your, hopefully, lots of time and lots of effort into back testing. It's not enough to read books, people. You have to back test. You have to know statistically if your trading system works out. If you don't know that, you need to go back to the drawing board, stop trading, and figure that out first. And then when you fund that account, be smart with it. Be patient with it, be kind to it, and be good to yourself in the process. That's right, there will always be another trade. Exactly. Take your capital very seriously. Don't just throw it into an account and say, well, I'm just going to learn with that money. Unless it's actually money that, you can afford to lose. $50, right? Okay, fine, learn with that money, but don't make it your IRA. Don't make it your mortgage payment. There's no reason for anybody to believe that they have to lose a lot of money to learn how to trade well. Absolutely not. Okay. Nothing about indicators? No, not in these sessions. I talk strictly about support and resistance. Even on the charts that I do have indicators, I have an 800 simple moving average because it's a common place for a price to get back to. And then I just have a default MACD up there as a measure of market sentiment. Nope, this webinar is all about price action. This is all about understanding the story that's being told by how the market is buying and selling. How much should a beginner start with? That's so individual. Honestly, I think if you have 10 grand to trade with, you should put $100 into a pennies per pip account. Owanda, they're not the best, but you can trade for pennies per pip, literally a penny per pip. So I always recommend that first. Because as soon as you're feeling like you're ready to go whole hog and you've really got your system hammered out, you haven't traded live, you don't know how you're going to react. Are you going to stare at the charts, become compulsive, and do stupid things with your account? What are you going to do? You don't know that until you actually have that money on the line. So, all right. Well, great session, everyone. Thank you so much for being here. That's why a micro is a smart for absolutely. Yeah, absolutely. Again, I see so many familiar people here. Thank you so much for your dedication. I hope you're as dedicated to your own process. Please take what I say to heart. Hit the back testing. Evaluate your own ability to take trades. Find your own statistics. Mine your own data. Be patient with your process. You're making a major shift if you're deciding to trade for a living. And that's not easy. It's really not. It takes a lot of time. I will see you next week. Be good to yourselves. And I'll see you next time. Thanks, everybody. Bye-bye.